We always call it the golden rule, right? When you have one spouse that's doing W-2 making money and you get the other spouse that's a real estate professional, you will never pay tax again, ever. There's so many options with the category. But you're right. We get calls from people that both the husband and wife are W-2s, or you're single. You don't have somebody to play tax games with, right? And so you've got a W-2 and you've got a couple, 3, 4 rental properties, right? What do we do? You have an operating business, right? Maybe you set up an operating business for your kids to go do a car wash, right? What can we do there?
Hello, everyone, and welcome to the Journey to Multifamily Millions. I'm your host, founder and CEO of Zana Investments, Tim Little. And on today's show, we have with us Shauna, the tax goddess Wekherlien. Shauna is a certified public accountant and founder of Tax Goddess Business Services, where she helps business owners, investors, and entrepreneurs create plans of action to increase their bottom line, reduce costs, reduce taxes, and increase cash flow. Shauna, welcome to the show.
Aw, thanks so much for having me. We're talking about some of my favorite subjects, so I'm excited.
All right, now we'll get into some creative tax strategies and all that stuff. But before we go there, please tell us more about your background and how you got started on your journey.
Absolutely. It's an interesting story, but I'm sure most are. So I actually started off in astrophysics, of all places, not anywhere near tax from that standpoint. And I got to give you a little bit of background, right? I'm German, if you couldn't tell from the Wekherlien last name, big, long last German name, which means that both my mother and father are very stoic, very specific, organized, right? And there's a reason for this. So here I am, happy little Shauna. I'm off at college. I'm doing astrophysics. Okay. I'm absolutely in love with my life. My dream was to go work for Jet Propulsion Labs. That's what I was going to do. Right. Come home one summer and I'm sitting across the kitchen table from my mom and she's opening the mail. Right. And now, stoic woman. Okay. She makes a sound, puts down the mail on the kitchen table, pushes back, like throws that chair back and walks away. And it's a little shocking for a German daughter to see a German mama do that, right? I was not expecting that in the slightest. And Mom, are you okay? Well, I got a notice from the IRS. Oh, the tax CPA said they have this. The tax attorney said they have this. They want more money. Just frustrated and upset, right? Because who wants to get a notice on a Saturday morning from the IRS as you're opening the mail? It's not exactly most people's favorite cup of tea. Thought went through my head as she's explaining that her so-called experts couldn't do anything for her. And I said, okay, listen, I'm astrophysics, right? But I think I'm maybe smart. Okay, let's go check it out. Let's go see what I can find. So being a scientist, right, I started digging into everything, right? Getting my hands on everything I could find, accounting, finance, tax, the legal side of tax, court cases, all of this kind of thing. And it did take me a few years. Okay. I will admit, unfortunately, I am no longer 18. Okay. It's a little bit past that at this point.
You and me both.
No, isn't that the truth, right? A little bit past that, but as time went on, went through KPMG. So I'm ex-KPMG, big accounting firm. I always call it the Goldilocks, right? Big accounting firm, medium accounting firm, small private, learned a ton, right? Switched specifically into tax. Started gathering all those letters after my name. So CPA, Masters in Tax, Certified Tax Coach, Certified Tax Professional, Certified Tax Strategist, which basically in the long run means that if you look at, according to Google, there are 660,000 CPAs. They do all sorts of things. There are 15 certified tax strategists. I am in the top 1% in the country for what I do now. And at this point, and this is actually the title of the book that we just published last year, my mom is now a proud member of the 6% Life group. Her tax rate, along with our client average, is less than 6.92% per year. No longer any tax issues or concerns. And that's how I ended up here. I had an upset mama. And I don't know about y'all, but when my mama gets upset as a daughter, I do everything I can to fix it.
Okay, that's awesome. And we're definitely going to get into some of that tax stuff because I have some questions on that specifically. But I think it's funny that you started with astrophysics. When I was in middle school, I was obsessed with astrophysics. It used to drive my parents crazy because I'd sit in the back of the car and talk about how black holes were formed. My favorite book at the time was The Universe in a Nutshell, Stephen Hawking. But yeah, it faded at some point, probably as I got much worse at science as it started to get math involved. And I did not like that at all. once the two collided. Then you got into the tax space and you talked a little bit about, I hesitate to say pedigree, but there is this kind of line for people that are in the accounting space. There are the top four, I think they are. You got your KPMG.
Price
What are some of the?
Waterhouse. Yeah.
Yeah.
So KPMG, Price Waterhouse, Ernst and Young, and this is terrible, but my brain always dies on the fourth one because they're like way at the bottom.
Oh.
I feel bad for anybody that's out there Deloitte and Touche. There we go. Deloitte and Touche. So
yeah, Deloitte. I was going to say Deloitte, right?
D&T. Yep. Deloitte and Touche. So yeah. So I was, in a way, I was a little bit blessed from that standpoint. I was going to join Anderson. And then right before I joined Anderson, interviewed with KPMG, and I'm like, I like that better. And now we know why, because Anderson went under for doing very bad things in the tax world. So anyway.
Yeah. And that's a whole nother conversation. If people don't know about that, it's pretty impressive, Enron, etc.
Mhm.
But so talk to me a little more about those designations that you just spoke of, because again, that was a long list of letters.
Yes.
And the one you settled on was the tax strategist one,
Yes.
which I had never heard of. But before you go into that, could you talk a little bit more about the CTC and CTP?
You got it. So yeah, the easiest way to think about this is, and the conversations all go together. So I think we can work through that all together. CPAs in general, most people know what a CPA is, certified professional accountant, right? It's a very common designation, but CPAs do a million different things. So they could be a bookkeeper, they could be an auditor, they could be a tax person, they could be a CFO, right? They do a million things. And side note, little tip for anybody in the audience there, CPAs hate being asked if they do taxes because basically only about 10% of us actually do taxes, right? Most of us do other things. So the baseline is the CPA. That's where you start really, or maybe enrolled agent, CPA, you really start looking at numbers and finance and that kind of thing. The next designation up when you start to specialize in tax is the master's in taxation. Now, there's only 60,000 people with masters in taxation. So you're already at 10% of the total number of CPAs that do tax, specifically tax. When you go up from there, you start looking at the certified something, right? So CTC is certified tax coach, okay? These are people that, again, now they've specialized even more than the masters in taxation. They're good. They've written tax plans. Average savings working with a CTC is typically anywhere between $25,000 and $100,000 a year for a standard taxpayer, a typical taxpayer. Okay, so still pretty good money. $25,000 to $100,000 a year is a lot of money to be adding back into your pocket. When we talk about CTP, that's certified tax professional. Okay, so CTC, there's only 607. So now we're down to 1%. Okay. CTP, there's only about 150 in the entire US. So that's certified tax professional. CTS, which is the top of the top of the top of all the tax strategy people, there's only 15 of us. And so I think the actual calculation works out to something like 0.9 zeros and then a 2, okay, of how many of us exist in the US. But yeah, we get ranked, the CTS people get ranked on how much money we save our clients. So, for example, Tax Goddess, me, my company, right? This past year, we're at 1.57 billion in savings for our clients. So we get ranked based on how much money we save and keeping people very happy, above board, out of jail, legal, all the good things. So.
Yeah, and help me understand, because you talked about the 6% tax rate, and for most people that at least seems unattainable.
100%.
So help me understand who that is even possible for, because you're also talking about businesses, you're talking about individuals, some amalgamation of the two. Where does it make sense for you to tell a client that you can get them that low? And I'm sure there's a spectrum there that you can probably talk about.
100%. And let me back up here. I'm originally Canadian. Okay. And so this comment will make sense here for a minute. In Canada, your taxes are a percentage of what you make, period. Okay. There's 2 deductions. That's it. There's no strategy. There's no planning. Maybe you set up a separate company. Like, it's very strict from that standpoint. One of the things that I am now a proud American. Okay. One of the things that I love about being an American citizen is that with all of the rules that are written, it applies to everyone. Everyone. It doesn't matter if you're making $10,000 or $10 million. The rules that apply to the government apply to you, apply to businesses, and there are thousands of tax deductions, of tax strategies that apply to everyone. Okay. Now, I do always have to throw in a little caveat. Okay. Something like, for example, this is real estate, right? We're talking real estate. Something like a cost segregation works best for real estate professionals. Okay. But if I'm a W 2 employee working for Apple and I have a rental property as an investment, I can still do cost seg. It just means I might not get the same benefits you do. When we look at who can get to the 6.92%, right? Anyone can get there. And it's really a question of how much, and I hope I'm allowed to be a little risque here, right? How much of the pain in the ass do you want to put into working with strategies? Okay. Because there are some strategies that are super easy, right? Like people tell me the goddess waves the magic wand, right? Wave, poof, done. I've saved you $6,000. Okay. The little strategies tend to be really easy to implement. Okay. The bigger strategies that save you 100,000, 200,000, 300,000 in tax, those are a little more complicated, right? They're not hard, but they're complicated. You got to fill out forms, you got to set up businesses, you got to do things with them. Now, if you were to say, Shauna, what is the kind of that sweet spot, right? Really what you're looking at is people that are paying about $100,000 a year in tax, because at that mark, at that $100,000 a year in taxes, now this is how much you've withheld, how much you've paid in quarterly estimates, all the taxes you pay. If you're paying about $100,000 a year, this is where it makes sense to use above and beyond the basic strategies that your normal CPA who does taxes is going to give you. Things like putting your kids on payroll, buying a new car, buying that one extra rental property and doing cost seg, right? These are the low hanging fruit, what we consider baby basic tax strategies. Okay. So when you hit that 100,000 and you've already implemented the baby basic strategies, that's when you need a strategist, right? That's when you start to want a specialist, because at that point you've done everything you can think of. You're still writing a hefty check. So how do we get you down? And what do we do?
Okay. And obviously, everyone's situation is different, right? You have some business owners, you have, say, someone like me who's an operator, right? I
Yep.
am a general partner in multiple multifamily deals. And then you have my counterpart who is the passive investor,
Yep.
who has a full time job, but they passively invest in these deals. And I think it's important for people to understand that there are tax advantages to both of those individuals, but in very different ways. And I'll just give a quick example. We hear a lot about real estate professional status, right?
Always.
And for 2 years, I was able to take advantage of real estate professional status because I was making, more money, most of my money from real estate versus a full-time job, i.e. I was doing it full time. Now there are certain requirements like you talk about that seem like a pain in the ass, like logging time and all this stuff to show if the IRS comes asking for it, to prove that you went to these meetings, or and how long were they, and et cetera, et cetera. But the payoff is that, again, and I'll simplify this, but for real estate professional status, I can take deductions greater than just my investments, especially if I'm filing jointly with my wife, who has a regular job, gets regular pay. Now I can write down her income as well to lower our overall taxable income, which can be a huge advantage, especially if they're pretty decent earners.
100%. We always call it the golden rule, right? When you have one spouse that's doing W-2 making money and you get the other spouse that's a real estate professional, you will never pay tax again, ever. There's so many options with the category. But you're right. We get calls from people that both the husband and wife are W-2s, or you're single. You don't have somebody to play tax games with, right? And so you've got a W-2 and you've got a couple, 3, 4 rental properties, right? What do we do? You have an operating business, right? Maybe you set up an operating business for your kids to go do a car wash, right? What can we do there? So I think one of the most important things for people to take away, really two pieces here. One is what kind of, we always call it a chessboard, right? Every single person has different chess pieces on the board. The rules are the same, right? What the rules apply to you, apply to me, apply to Bob, right? Everybody has the same set of rules. But if you're married with 3 kids and I'm single with 2 dogs, how do those rules apply to us differently? What are we investing in? What are the goals? What do we want out of our money? Are we charitable? Do we want to pass on an empire to our children and have them build it for the next 30 generations? Do we want to pay off debt? Well, all of these pieces, the chess pieces of life, change which strategies apply to any given individual. So,
Yeah. And so, in terms of that passive investor, it's pretty straightforward regarding like a W 2. Hey, passive, Mr. Passive Investor, Mrs. Passive Investor, here's your K1 showing your paper losses for this property and any gains, distributions that you might have received from this investment. Are there any other creative ways that they can work down their taxes that you've run across, or that you immediately think of, oh, you haven't done this yet? That's the first thing. Is there anything else?
love it. If we're specifically talking about passive, so just a little broadening here for the audience today, your W 2 is active. If you were a real estate professional, that's active, right? And so the IRS will split passive income and passive losses from active income and active losses. And those two things are kept in two very distinct buckets. Okay. So let's go in this example. We've got a passive investor. The K1 is showing a loss, right? Passive losses. Now, those losses are going to get trapped because there's no passive income, right? There's no additional cash flow. Nothing else is creating passive income. So let's go look at a business that creates passive income. Now, you might be able to buy some interest income in a partnership. That would be passive. You might be able to join a real estate syndicate, which would be passive, and it would be positive income to offset the losses. So you're gaining income, but you're not paying any tax on it because the loss from the original K1 is offsetting. Now, you can also look at other types of businesses, other types of investments if you want to diversify. One of my personal favorites, specifically for passive, is Turo. So Turo is a car leasing business. Okay. And we have quite a few clients that want their own Lamborghini and they want their own whatever, right? The brand new Tesla, whatever it is, the G-Wagon, whatever.
G-Wagon. Yeah, you gotta say the G-Wagon.
We're all about the G-Wagon, right? There is a business model out there called Turo, which allows you to rent your cars to somebody else. It is more like a turnkey business, depending on how many cars you have and how you set it up. But it is considered passive for most people because you are normally not the person actively like cleaning the car or maintaining the car, doing all those active activities. So if you want the Lamborghini and the G-Wagon sitting in your front drive and you want to be able to drive it, consider setting up a Turo business that is passive income against passive losses from your real estate. So you're getting all that cash, but you're not paying any tax on the cash. So pretty cool options.
Yeah, and I think that's where it comes down to a tax strategy. Too many people just think, oh, here is the situation. No, you have to take in that whole umbrella. There's all these different things under the umbrella. This is just one. So when I talk about this, it's in a broader context, right? I'm assuming most passive investors have other investments. Like it's more likely than not. But even for the sake of simplicity, when I'm explaining to someone who has never done any kind of
It's their
passive
first deal.
investment before.
Yeah.
Yeah. If I'm explaining to them, I do it like you just did to say, hey, again, oversimplified, but imagine you made $2,000 from this passive investment over the course of this year, and then you get a K1 that says you've had 2,000 in losses. Guess what? You just made 2,000 tax free.
Yeah.
It's a little oversimplified, but it gets the point across, and then you could do any combination of different investments that the same way.
Yep, 100%. And I think really that's a part of the key, specifically of tax strategy, is what is it that the person themselves wants, right? And I feel like a lot of people get into investment strategies, options, because they heard about it on TikTok. You heard about it on this podcast, okay? Hey, she was talking about this Turo thing. Let me go check that out. Not every strategy works for every person. So be very careful that if you're going to get into a strategy, you're doing your due diligence with actual professionals that can tell you, in your case, specific to you, based on these 80 other factors that you have in your life, is this really going to work for you? And especially for passive, because the IRS is on the lookout for some of these passive going active things. And so you want to be really cautious and just above board with whatever it is you're doing. So,
yeah. And that was actually segues quite nicely in what I was going to ask you with regards to how much re-education is the right word based on what people are seeing on either YouTube, TikTok, because I watch a lot myself on
Me too.
YouTube Shorts, tax attorney who watches like TikTok
Faces.
influencers giving
Yeah.
just horrible advice.
Yeah.
And I'm wondering how many of them come to you, how many people come to you like, hey, I heard I should be doing this. And you're like,
Oh,
no, don't do that.
all of them. So let me back up here. Okay. Before TikTok, before YouTube, right? Before we really went to a social media world here, that people would come to you and say, hey, my neighbor is doing this, right? So it has happened since the dawn of time, right? When fire was invented, the guy living next to the guy who created fire went, oh, hey, that's pretty smart. I'm gonna copy the thing. It's not like it's a new concept from that standpoint. I and I will come at it from this standpoint. Okay. I love TikTok and I love YouTube. Okay. However, big caveat here. Okay. Watch TikTok and YouTube to get the idea. Oh, hey, I can pay my kids. It is a great idea. It's a valid idea. There's no problem with the idea. Do not, under any circumstances, use TikTok and YouTube, even GPT. Everybody's, well, take the idea, go to GPT and it'll tell me what to do. No, the doing of it, you absolutely need a professional. You might need an attorney, you might need a real estate broker, you have professionals for a reason. And I understand a lot of people, oh, GPT is going to wipe out all the professionals in the next 5 years. There's something to be said about somebody's got experience. They know how the IRS agent is going to react to if you use this word or that word on the return because they've seen it and they've done it, right? And I could be wrong. In 5 years, I could be listening to this podcast, laughing to myself, going, oh, GPT just totally killed my job. But for right now, guys, please get the idea from TikTok and YouTube or wherever. I love it. Ideas are gold, and that's how you make money. Because we have seen case after case of people bringing ideas. Wall Street Journal, Harvard Business Review, okay, bringing ideas to their CPA, and the CPA, I'm getting all worked up about this. The CPA tax preparer says, no, that's not going to work. It does. They just don't know, or they've never seen it, or they aren't willing to do the research. I love ideas, how to do it, what, where, when, how, why. You want the professional. So,
yeah. So what is the most common TikTok influenced advice that you've heard from people that they come in with? Is it buying the 80,000 pound car so that they can get a 100%, or is it one of the other ones?
I would say it's typically buying something. Buy the Rolex, write it off. Buy the yacht, write it off. Buy the car, write it off. It's typically buying a thing. And they're typically the luxury things that everybody wants to buy. I think one of my favorite ones that I saw recently was how to buy a Louis Vuitton and write it off. And let me back up. You can. I will 100% tax goddess. I think I know the guy you're talking about, the Edward Verify dude or whatever. He's awesome. I love listening to his stuff. But you can write off the Louis Vuitton. But do you want to know how? Because I do not want you to just go to the Louis Vuitton store and buy the whatever $80,000 bag and put it on your business credit card as an expense. That will not fly. I promise you it won't. But if you know how to do it, then yeah, why not? If it's a valid business expense, there's really 3 key words anytime you're looking at anything that you're trying to buy: ordinary, necessary, and reasonable. Why is that Louis Vuitton purse ordinary, necessary, and reasonable for what you do in your business? If you can explain that, and you just laughed, if you can explain it and keep a straight face and the IRS agent believes you, let's do it. Let's deduct it, right? But it better meet those 3 qualifications. Otherwise, you're cooked. So,
yeah. And I think most people, they tentatively get over the first 2, but that reasonable hurdle, I could go buy a Patek Philippe $100,000 watch just because I'm like
$20 Timex, man.
Yeah, because I'm trying to flash it during my podcast doesn't make it necessary, reasonable, or you know what I mean? So
100%.
yeah, people need to be careful with that. And I find a lot of people think that being able to have a tax deduction means that they should have bought the thing. Like I've talked to small business owners who are like, yeah, I just bought a truck for 80,000. I do lawn care. I'm like, okay, that's great. As long as you absolutely needed that truck. They're like, yeah, but I'm gonna get a deduction. Yeah, but couldn't you have bought a $40,000 truck? Like
a $12,000 one? It's gonna get beat up with all the tools in the back of it. Are you kidding me? Like, yeah, no. And you hear this all the time. Oh yeah, this is my 8th truck that I've bought in 8 years. I'm like, so you're telling me that? Listen, if you have 8 crews, great, let's do it. Then you need it. That's fine. But it's you in your house with your wife and the one son. And this is a real example. Okay, it's you and your wife in a house with one son. and you need 8 cars, you need a fleet of trucks that you can't even drive on the same day. Why? But literally depreciated the instant you drove it off the lot. Oh, that's what my CPA
Yeah.
told me to do. And it breaks my heart. It breaks my heart because that cash, way early on in this podcast, you said cash flow to you, not to the dealer, not to the government, not to a bank, to you. How do we get cash flow to your pocket so that you can buy another property, expand your business, hire the assistant that you desperately need, not hand it over to a car dealer? Sorry, you got me on my soapbox. I apologize.
Yeah, no,
Sorry.
absolutely. I wanted to make sure it wasn't just me.
Nope. No.
One of the ones that I hear a lot in real estate circles is the hiring your kids one. So maybe you could just quickly explain where that makes sense and where it doesn't. I think we can all agree if they're not old enough to walk, then we can't say that they were working in our properties.
I'll give you the court case
please
for
go
that
on.
one. I'll give you the court case for that one. I love it. So there's 2 different ways to look at this. Okay. There's 7 years old is the current accepted, they're old enough to do a thing. Okay. Because it's 7
Okay.
years old, they can empty trash cans, they can sweep the front path, they can pick up gravel, they like whatever, right? At 7 years old, they can plant plants in planters, they can do things. So 7 years old is the cutoff line, the dividing line. Now, there's a court case that specifically talks about 5 levels of cute. Okay. So there's one exception to the 7-year-old, at least in my opinion, right? Every CPA and strategist has their own opinion. For me, it's 7, and then this court case. If your child qualifies as a child model, okay, so think about the Gerber baby, okay? The way the court case basically reads, the judge said, listen, this kid literally cute verified by a modeling agency. So basically you have to take your kid to a modeling agency and say, would you hire my child to be the face of Gerber baby food or whatever, right? If your child is 5 levels of cute, then great, let's do it. Hire the kid, less than 7. I'm in. You've got it verified, third-party modeling agency signed. Yes, we're in. We'll hire this kid. That is a third-party external proof of why are you doing that. So then the question becomes, okay, well, if you really do have this super cute kid, how are you using that kid in a way that's ordinary, necessary, reasonable to your business? So we come back to those 3 key little words, right? You might be able to get away with 1, 2, 3 photo shoots every year of the baby on the couch in the rental home looking all happy and cute. Like maybe that goes on your website, whatever. A photo shoot can cost, if you were to hire a child model, photo shoot can cost anywhere from $500 to $15,000, depending on the age. What are you shooting? How many shots, right? You can see some rather large numbers. And of course, you can do photo shoots with older children, 7 and older. The biggest place where people get into trouble here is that they'll pay their 7-year-old $150,000 a year to sweep the front porch or whatever. We go about reasonable, right? Ordinary, necessary, reasonable. You have to be able to prove that you would pay somebody else you'd pay somebody else's 7-year-old that amount to do that job. So 150 is probably not valid, but $10,000 a year to sweep the front porch of 15 properties? Maybe, right? So a lot of it's going to be dependent on where you live, right? Big differences of the Midwest versus Manhattan. But yeah, it goes back to reasonable, right? And the kid has to do the job, right? You can't just say they did the job. They actually have to do the job. Time records, just like the real estate professional, time records, dates, pictures of them sweeping the porch, looking all upset because they're cranky, that they have to sweep the porch. Those are good things in your IRS file.
Okay, awesome. And I appreciate that you added some of those things that you need to back up your case,
100%.
right? Because a lot of this comes down to cataloging, evidence, time,
100%.
etc., paperwork.
Yep.
So much of that, not necessarily because they'll ask for it up front, but if you do get audited, then you will need it. And you don't want to go looking for it after the fact, right? Because that's a bad place to be in, I imagine. Luckily, it hasn't happened to me yet. But so we discussed a few of those. Please talk to me quickly about just the most overlooked tax deductions or strategies when it comes to multifamily real estate.
Specifically, I think that there's 2 really big ones that I want to point out. One is separating your operating business from your actual ownership. Entity strategy and structuring can be a big deal. It actually means some really important things for not only your tax return, but also you as a person. If the only way you have your rentals is separated for legal purposes, the separate LLC, and here's my duplex and my separate LLC, and here's my fourplex, whatever it is, by having an operating company, you are now creating active income. Okay. So these guys might be passive. This might be active. With active income, now you can use other strategies, things like the master's exemption, which would be my second favorite, probably my favorite tax strategy in the code, to be honest with you. The master's exemption allows any individual to rent out their property. So your primary home, secondary home, vacation home, whatever it is, you can rent out any property you own. Mortgage is okay. You just can't rent it. Any property you own for 14 days a year, and any amount of income that you receive in those 14 days a year is 100% tax free. Now, a lot of people think, okay, listen, I've got my rental property and I already have somebody living in there 300 days a year, right? So it's not going to work on that property. But if you have an operating company, your operating entity can, let's say once a month, do a vendor management meeting in your home to go over with your vendors, how do you want the landscaping done? How do you want the driveway cleaned? How do you want your 7-year-old, who's now an employee of your company, to manage taking out the trash, right? You can have vendor meetings, business meetings, networking meetings, staff meetings, whatever it is. That is a business purpose. It is reasonable. It's ordinary that you would have meetings with your team, your vendors, your partners. Maybe it's a mastermind group with other real estate professionals, right? Having that operating business, the operating business can pay you personally to rent that space. Again, depending on where you are in the country, we've seen as low as $500 per event. The highest I've ever seen was Manhattan, now at $19,500 per event. And if you can do 14 of those a year, we're looking at some big dollars that are 100% tax free for you. It's a deduction for your business. There's some really pretty things you can do.
Okay, that's interesting. So you're saying even like your personal residence,
Yep.
and my mind starts going to, okay, how do you defend that from the reasonable perspective? Is that just a matter of looking at like Airbnb prices and showing
So
what the rental rates would be for something of
yeah.
equivalent size, or
So be very careful about this. And I'm so glad you brought up Airbnb. Okay. When you rent an Airbnb, why are you renting an Airbnb?
because you want to stay overnight there?
You want to stay overnight there. Typically, renting an
Mm.
Airbnb in a place where you're not holding a business meeting. Typically, you're going somewhere, you're going on vacation, right? That is a different kind of rental. Okay.
Right.
If you were going to hold a business meeting and you had to rent a space for a business meeting, typically that means you're going to be in a business center, in a conference
A
center, a
hotel,
hotel,
conference room, something like that. Yeah.
and those are not cheap. And so
Yeah.
this is where a lot of people underperform for themselves as they go, oh, Airbnb, because that's what I know. Well, an Airbnb is $150 a night or whatever the rate is. A conference center for a 4-hour event can be $3,000. So you need to be looking at the use of this space. Now, I have seen some people use a combination. So let's say, for example, you have a staff member that lives in North Carolina and you live in California, right? And they're coming out, they're flying out, they're going to stay with you in your home for 3 nights. You may spend, of your total of 14 days, you may do 3 at the Airbnb night rate and the other 11 at the conference room rate. So you do want to track, write it down. My favorite way to document, honestly, is to take a picture, take a selfie with everybody sitting around the table, selfie, click, and here's everybody. We're having a meeting, take agenda notes, those kinds of things. Have them sign in. It's one of the things I even have it at the front door of my home is I have a little red book and everybody signs in and says, why are we here? What's the purpose of the meeting? But yeah, any of that kind of corroborative documentation is really good for the files. So
Okay, no, really awesome. I had never thought of that before, but it did make me think of some of the other sketchy stuff that I've seen on TikTok where people say, hey, I fly to Hawaii, I stay in the Four Seasons with my family, and while I'm there, I do a couple of social media posts and have the annual meeting for my business, and then I write off the entire thing. And I'm like, that's not how that works.
yeah, you're
But
pushing.
it's like a piece of it, but not the whole thing, right? So I
And
think
that's TikTok. That's
right.
TikTok, that's YouTube, right? Because
That
they're in it
nugget
for the
of truth.
shows. Yes, it's
Right.
there. You can do that, but not the way they're describing it to you, right?
Yeah.
So if you're going to fly to Hawaii and you're going to take your family, first things first, what's the business reason for your family to go? So you better have hired your wife and your 2 kids in the
Right.
business and they have a business reason to go, right? The second bit is you need a business reason to go. So I would hold a meeting with a vendor on a Thursday. I would go look at a property, maybe 5 properties on Friday. I would spend the weekend because I'm not going to fly all the way back stateside to fly all the way back for another business meeting on Monday with a mastermind group that it specializes in multifamily or whatever. Get all of your meetings lined up, attend those meetings, take notes, take education. Why are you there? The wife, the kids better be scoping out rental properties in whatever district of Hawaii, like wherever it is you are. So we go back to, and that's what I love about those three basic key words. The IRS comes back to it over and over again in court cases: ordinary, necessary, and reasonable. So whatever it is you're trying to do, how for your business, for what you do, is it ordinary, necessary, and reasonable? And if you've got a good story and it's airtight and you've got proof, you're probably pretty safe. I can't say 100% all the time, but ordinary, necessary, reasonable, if you can get that, you're probably pretty good. So.
All right. So listeners, if you walk away with nothing, walk away with ordinary, necessary, and reasonable.
Nailed it.
All right.
Yep.
All right.
Love it.
All right. This has been awesome conversation, but we do need to move on to the turbo round. So I'm going to ask you 3 questions that I ask every guest. I just ask for a quick, honest answer. Are you ready?
Okay. Ready.
All right. What is one red flag every investor should look out for?
If your CPA doesn't know what a cost segregation is and can't explain it, you run away.
All right. Absolutely. Second question. What is a myth about this business that you would like to set straight?
Oh, about this, that you can do it on your own. You can do it on your own. If you want to do it well and you want to get big and you want to make money at it, you need a team. Absolutely need a team. Hands down.
Yeah, no, I 100% agree. Like you may be able to do it yourself on TurboTax, but I guarantee you're missing benefits and you're, what is it, like stepping over dimes to pick up pennies or something like that?
Penny wise, pound foolish, I think. Something like that.
Yeah, all of those things because you're not prioritizing the right stuff. All right, final question. What does success look like to you?
Hitting whatever your dreams are for you, your dreams, not anybody else's dreams, your dreams. What do you want? And hitting those and having your entire life be a dream. Every time you wake up in the morning, you get to do exactly what you want. Sounds like a plan.
Awesome. All right, Shauna. Thank you for making tax advice exciting and engaging. That's not the easiest thing in the world, but you did an excellent job.
Oh.
Please tell our listeners how they can get a hold of you and if there's anything else that you'd like to share with them.
Oh, thank you. We are super easy to find, taxgoddess.com. And let's see, the only other thing I can think to share, I have an app launching on September 16th in a couple of days. It helps people save money automatically. So if you are looking for ways to put cash aside for yourself first, profit first, check us out, Cash Goblin. So.
All right. We'll have all that information in the show notes. Again, Shauna, I appreciate you coming on, and I look forward to continuing to see you do big things on your journey.